Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, hello everyone, and welcome to this month's edition of our AWA Market Minute. Hey Scott, why don't we dive into the financial headlines?
Absolutely. So first headline we wanted to tackle today is Russian President Vladimir Putin made a visit to North Korea that elicited a lot of kind of news and interest, and almost a defense pact similar to what we saw in the Cold War.
Yeah, it's something that we're absolutely watching with great interest and terror as we watch these two become better bedfellows. They said it's been a long time since we've gone this deep with these two entering into some kind of a pact to help fund each other, share technologies, share resources. We don't like this.
No, we don't. And I think it's emblematic of kind of what we're seeing today, where great powers, be it China or Iran or, the North Koreans, where some of those alliances seem to be solidifying, and it is a troubling trend.
It's a troubling trend, and it's actually kind of almost borderline comical. They're not even trying to hide anymore.
Yeah,
right? They're the bad guys are just finding each other and raising their hands now.
Yep.
So let's shift over into NVIDIA has passed Microsoft in its market cap to become the most valuable public company. So about a month ago, they passed Apple at $3 trillion in market cap to be the second largest company. And just recently, they passed Microsoft now at $3.3 trillion. They are the largest public company, and their CEO has amassed $100 billion of net worth in the last 2 years. So for everybody a couple years back who said NVIDIA was on the ropes, they are not any longer.
Yeah, and this is an interesting one, and I think the $100,000 question for everyone is this sustainable? Is this, founded in fundamentals, or do we have a bit of a bubble right here? And I think one can make the case both directions. If you look at their market capitalization, it is greater than 10% of U.S. GDP.
That's right.
So that seems excessive, as does the price to earnings valuation of 80 times earnings. That's also problematic.
I mean, for years we weren't even interested in looking at them because of their PE ratios were so outlandish. We're finally seeing enough earnings that NVIDIA seems like it's palpable. But yeah, you're exactly right. Will this trend continue with the advance of AI and what NVIDIA's role in AI will be? So
yeah, super interesting. And the other thing that I think they keep in mind with NVIDIA is a lot of companies have built the infrastructure and almost overbuilt a lot of what they're doing. And so the question is, how much demand has NVIDIA brought forward? I.e., is this sustainable, or have they booked a lot of the gains already on that? And I suppose time will tell.
Time will tell.
All right, next one here. So the 4-day work week, is that going to become a permanent thing? And we've seen this a lot over the past several years, primarily in government sectors. We've seen a lot of that, but it's spilled over into private industry. What are your thoughts on it, Paul?
I think people are always trying to find ways to be more efficient, and everybody wants to have the the downtime opportunity to kind of go home and be with your family. We have seen it here in Utah specifically. A lot of our local municipalities adopted the 4-day work week, and I've talked to some people on the inside, and they said it sixes as to whether or not it does produce any more efficiency, because you're putting in the extra hours, and a lot of times those last 2 hours of the day, people are still kind of hanging their hair a little bit. It's not quite as efficient that time. So
Yeah, and I think it ties in with some of the trends we've seen with working from home, and we are seeing some adjustments to what our work life looks like. And some of these things feel almost like a transition from Western Europe, where culturally there's more of a kind of work life balance.
That's the goal.
Yeah.
I've spent some time in Western Europe, and I'll tell you right now, when we were there as tourists, and it was noon, and we were looking to buy lunch. And there was not a single restaurant open anywhere we traveled. It does get you a little frustrated when you think, come on, guys, we're here trying to spend our money.
Absolutely.
Scott, let's transition over into a different segment on a market update.
For a market update, let's begin with just what some of the major indices are doing. The Nasdaq's had a pretty good year to date, and pretty good is probably an understatement. Up 21+%, primarily driven by companies like Nvidia, right? The S&P is also up almost 16%, again driven by Nvidia and some of the technology companies. Interestingly, the Dow is up very modestly. The Dow's up about 3%. And the reason being is the Dow isn't comprised of some of those big tech names. And what it speaks to is how much the big technology companies have driven the lion's share of the market's returns.
Well, I think that's an important point, Scott, that, historically you watch the S&P and the Dow, and I think people will make the comment, oh, they kind of run in tandem and parallel. And you see this significant deviation from that kind of parallel operation this year, and I think it speaks to this next slide here. 3 stocks now account for over 20% of the S&P 500's value, and that makes a lot of people nervous, right? When you look at the Magnificent Seven, they account for well over a third of the overall performance of the entire S&P 500, and so you look at that number, that 15% performance for the year, and you say, okay, well, over a third of that performance is driven on 7 stocks. The other 493 stocks are accounting for the rest of that performance. So it does make you pause for a minute and think, okay, are we building a little bit of a bubble inside that S&P index?
Yeah, we get anxious anytime we see top-heavy markets. And if you look at market history, oftentimes declines are preceded by top-heavy markets. We saw that before the dot-com bubble burst. We've seen it at other intervals. And so that does make us a little bit anxious. And what it underscores is the importance of sticking to fundamentals. Yeah. It becomes hard not to chase the hot dot at these times, right?
Yeah, I mean, I think we get comments all the time with clients. They'll say, hey, we see the S&P performance and we really want to chase that. And we have to maintain some conviction here to say, look, diversification always does perform best. So there could be a scenario in the not too distant future where we see S&P returns have mean reversion, while simultaneously well-diversified portfolios like the ones that we espouse are not experiencing these significant pullbacks. And a lot of people are worried about big pullbacks, and we don't necessarily disagree, but we maintain that the best portfolio is a well-diversified portfolio.
Yeah, and you think back to like major market events like the 2008 financial crisis, diversified portfolios fared far, far better than the market overall. For context, the S&P 500 fell over 53% from peak to trough during that period of time. So, the idea, I think Warren Buffett said it, be fearful when others are greedy and greedy when others are fearful.
That's right.
I think that's applicable today. On the interest rate front, the yield on the 10-year Treasury is up by about 9%. We started the year just under 4%, is knocking on the door of 4.3% right now, although it has come down a little bit. Right now, the Federal Reserve is suggesting 1 interest rate cut between now and the end of the year.
We were promised 3, Scott. What happened?
Yeah, so I think what the Fed is seeing is inflation hasn't come down quite as quickly as they would like. Some of the more recent inflation data has been pretty solid, but the inflation target is 2%, and we're still short of that.
Yeah.
On just a few other tidbits, oil's price up about 15%. That's indicative of an economy that's in pretty good shape. And then gold, with other risk assets, has gone up in value as well. All right, so final thing with the market update. During periods of time where high-quality managers maybe underperform the index by a bit, it is important to keep this context in mind. So what this chart shows is for a given quarter, the top fifth of all money managers will lag their respective index 46% of the time. So that means it's almost a coin flip as to whether or not the highest quality managers beat the index over a quarter. Over a year, that number's 40%. So a little better than a coin flip, but not by much. But over 3 years, 5 years, 7 years, that's where having quality asset managers really proves their worth. And so investment success is measured in years, not in the short term.
Yeah, I think the example I've used here is, if I go back to the summer of 2002, I could show you that summer, Salt Lake City drew more rain than Seattle, Washington. And so if I were living in Salt Lake at that time, I could have pointed to my actual experience and said, no, look, Salt Lake is a wetter climate than Seattle, Washington. You zoom out any amount of time beyond those 3 months, and you would realize how silly that sounds.
Yeah, absolutely. And so, again, blocking, tackling, sticking to investment fundamentals.
Let's jump into our segment on expert commentary. Scott, why don't you introduce our guest commentator today?
Absolutely. So we're super privileged today to have Dean Hamilton with us today as our guest commentator. Dean Hamilton is a longtime industry expert in all things insurance, and Dean is a senior member of the annuity team at Allegis Advisor Group. And Dean, thanks so much for joining us today.
Yeah, thank you, Dean.
Paul, Scott, thanks for having me. I appreciate the opportunity to be here with you.
Absolutely. Dean, we wanted to invite you on to be our guest today for this expert commentary segment. One of the questions that we get asked regularly regarding annuities is annuities are so misunderstood in the industry. And I don't know anybody that doesn't have a very strong opinion on annuities. It's one of these conversations that we'll have where people are either all for the conversation of annuities and they say, hey, we've got to have all of our money there because the market's a scary place, or you'll see the opposite, which is, anybody who ever will purchase an annuity is absolutely up in the night and they should never have anything like that in their investments. I think Scott and I try to take an approach far more objectively regarding how annuities work and what they do well and what they don't do well, and try to take an approach of where do they fit, if they fit at all, in a retirement plan. And so we wanted to invite you on today to kind of talk through and maybe kind of fact from fiction, what annuities are, what they aren't, what they do well, what they don't do well.
Great. Happy to help.
Awesome.
Yeah.
So let's start out. Maybe let's go through some of the different types of annuities, because the term itself is applied, across the industry for many different types of vehicles. And I think that's where a lot of the misinformation and confusion comes from, is the term is broadly applied, and understanding the specifics of what different types of annuities might be helpful. So let's start out, Dean. What is a fixed annuity?
So a fixed annuity is an annuity that pays a certain interest rate, typically for a period of time. An annuity at its core is really designed to create an income stream. And so fixed annuities kind of fall in that vein, but then there's also different variations of that. So there could be like a fixed deferred annuity or a deferred income annuity. There's a couple of different types of annuities that fall under the fixed annuity category.
Perfect. So let's break down a couple of those different types. One that we hear a lot about are this conversation, FIA, or fixed income annuities. Can you help us understand a little more about what an FIA is?
You bet. And an FIA could be a fixed income annuity. Typically, that applies to the fixed indexed annuity, and that's typically a fixed interest rate, or a fixed annuity where there's no market loss. So your principal is not subject to any market loss. You're not in a market. You're not up and down with the market. You have a floor of zero. You can't lose any money in that annuity. And then your growth is tied to a stock index, typically. Or it could be a hybrid index where it's a blend of stocks and bonds, or bond futures and historic stock performance. So there's a couple of iterations there, but typically your interest is earned based on the performance of an index. And if that index does not perform that year, you don't lose anything because you're protected on the downside at a zero floor.
Perfect. So it's actually not invested in the market. They just use the index as a barometer, so to speak, of how they're going to earn, what kind of interest you're going to earn that year.
Yes. Yep.
Okay. Now contrast that with something like a multi-year guaranteed annuity.
Yeah, great. So a multi-year guaranteed annuity is very much like a CD or a certificate of deposit at your bank or credit union, right? You're going to get a fixed interest rate for a fixed period of time, and you know exactly day in, day out how much interest you're earning in that account for how long. Where with the indexed annuity, if the index is up that year, you get interest. If the index is down that year, you're protected on the floor at zero. With the MYGA or the multi-year guaranteed annuity, you get that fixed interest rate every year for whatever period of time you guarantee.
So this could be a good alternative to a CD if the rates are positive.
Yeah, I mentioned it's very much like a CD. There's a few benefits that you get from having your money in an annuity, especially if your money is non-qualified than you would get from a CD. In a non-qualified CD, you're paying tax on any interest earned every year. You get a 1099 from your bank or your credit union. In an annuity, a MYGA, a multi-year guaranteed annuity, you're getting tax-deferred growth. You get to bypass probate. You get all of the safety that your bank would offer you, basically, but you get a few additional bells and whistles alongside that.
Very, very cool. Very cool. Talk to us a little bit about there's some differentiation in terms of annuitization versus just taking withdrawals out of my account versus the other conversation, which is taking an income rider and taking out an income stream. And I think some of that plays into some of these different kinds of products, correct?
Yeah. So annuities are definitely designed for income. We talked about an annuity in its core is really just a stream of payments over someone's life expectancy is basically what that is. And that's called the SPIA. And basically what you're doing when you take a SPIA, and that stands for single premium immediate annuity. If a client wanted to generate a pension type income, they could take a lump sum of money, give it to the insurance company, and that's going to create that stream of income over their life. And that's
going to be based on the life expectancy of the individual, all the factors that create that.
Yes, yep. And that's when you mentioned annuitization. That is the definition of annuitization. They're taking their money and they're annuitizing it or turning it into this annuity, right? And basically they're taking their money in exchange for an income stream. They give that money to the insurance company, and then the insurance company creates that guaranteed lifetime income. That's annuitization.
So really quick on that, Dean, annuitization in its rawest form like that, and maybe the more kind of pure form, if you will, if the recipient of those payments passes away, what happens? Is there any kind of residual benefit, or is that?
Typically, that's that. And Paul, you mentioned a lot of confusion and things in the marketplace around annuities. Annuities have a bad rap. This is one of the reasons why annuities get a bad rap, is because in its truest form, annuitization is an exchange of that premium for the income stream. And if that person dies, even the next day, there's nothing left to go to their beneficiary, right? They've given up that income, they've given up their money, and now they have nothing left to pass on.
And so this is a little bit like a pension, right? I mean, if you work for 40 years for Boeing or the railroad company, and they qualify you for a pension, you could receive that pension for a year or two, pass away, and then it's gone. It's a similar conversation. It's also one of the reasons that we are leery of annuities as well, because you'd hate to invest all that money. If you annuitize that contract and pass away, it could be gone. And so there are other versions that don't require that annuitization.
Right.
And that's where you see these income riders, where you can still maintain the corpus of the investment while still drawing out a lifetime income stream. Talk to us a little bit about income riders.
Great. So income riders, been around 20 years now or so. going on maybe 30 years now, I guess. But they typically they sit on top of an annuity. So for a long time, the only way you could get these was in a variable annuity, and we haven't talked about what that is yet, but we'll address that in a minute. But as of the last 10 years, you can get them on variable annuities, you can get them on fixed indexed annuities, the FIAs that we just talked about, and you can have them on fixed annuities as well. Typically, your best performing income riders, and there's differentiation in each of those types of annuity riders, those income riders that can go on those annuities. You get the best income typically from an indexed annuity with an income rider or a variable annuity with an income rider. And basically what that does is the rider just kind of sits on top of that account value. It allows the client to retain control of that asset, right? It's still earning interest. If they pass away, whatever's left in that account will go to their beneficiaries. But then it also is utilized by the insurance company to create a similar pension type income that's guaranteed for as long as that person lives, or as long as that person and their spouse lives. You can set it up as joint income. You can have it as single income, and it provides income utilizing that underlying asset. And even after that asset is diminished, the income still continues for as long as that.
I think this is one of my more preferred versions when we utilize annuities in retirement planning, because I think there's some benefits here where if the annuitant passes away, that asset hasn't disappeared. They can still say, hey, there's a beneficiary, the children or a trust or somebody can still take the corpus of that investment, whatever's left, and pass that on to them. And so it's not like they forfeit that if they passed away early.
Right. Yep. That's exactly right. And there's some differentiation there as well in how how those are structured and what you're looking to do. So we're talking about lifetime income, but you can also get access. One of the negative connotations to annuities, as you kind of addressed at the beginning of our segment here, was that there's a lot of confusion around them, a lot of negative feelings and thoughts. Everybody has opinions about them. A lot of people think that once they put their money in the annuity, that it's just gone. They can't get access to it anymore. And so there's different ways that you can create income from an annuity. There's the immediate annuity or annuitization, like we just talked about. There's the income rider, like we just talked about. There's also what we call a bucket approach, or just free withdrawals, where you can actually draw money out of your annuity up to a certain percentage without incurring any surrender costs or anything like that. So there's different strategies that we can utilize in implementing an annuity in someone's plan.
And there's a different version that we haven't covered called a variable annuity, where you're effectively purchasing a mutual fund wrapped into an insurance product, and it's an interesting version because in that version you can in fact lose your principal. You can in fact have market fluctuation adjust whatever the value is up or down. I think a lot of people get some confusion about that product because you put that side by side with a fixed index annuity, and they have very different outcomes. Or one has principal protection, the other does not, and both can be called annuity, and that gets confusing.
Exactly.
Yeah. And also the variable annuity will come with its own layers of costs. And I mean, Dean, what are some of the more exorbitant costs you've seen on the variable annuity sides?
Yeah. So, and it's interesting that you bring up costs. So let's talk about costs in a rider. We talked about a MYGA. There's typically no cost to a MYGA, right? You get that fixed interest rate for a set period of time. We talked about the FIA, or the fixed indexed annuity. There are costs associated with adding an income rider to that, but the underlying account has no costs, right? So you can go into an annuity. Typically, there's no cost. In an indexed annuity, you're going to get that market growth based on the performance of that index up to a certain percentage, but they're going to limit that because you're protected on that downside floor, right? In a variable annuity, you have no protection on the downside, unlimited upside potential, but then you have all of these different costs layered inside of that. You have a M&E charge, which stands for mortality and expense charge. Typically, there's an annual fee. There's different different costs to the sub accounts inside of that. So the mutual funds that you're purchasing.
And those can be the exact same as buying the mutual fund on the market. I mean, you can be paying 1.5% just on that one cost alone.
Just on that part, yeah. So M&E cost is typically right around 1% for most accounts, from what I've seen. And then sub accounts or the mutual funds inside of the annuity, anywhere from 50 basis points to 150 basis points, so 0.5% to 1.5%. And then if you add an income rider on top of that, you're looking at another 1 to 1.5, maybe even 2%. So in a variable annuity, you're seeing, you have some really significant upside potential, but you create a hurdle for yourself that you have to get over in order to get that growth. Because in fees alone, you could be anywhere from 2.5 to 4.5% in fees before you get any return credited to your account.
Yeah, I think in conclusion, the summary here is annuities are very complex. There's a lot that goes on there, and it's very important that when you consider utilizing an annuity in your retirement plan, that you are working with an individual that can explain all these nuances with you. The reality is that I think the biggest complaints consumers have regarding annuities is the misunderstanding and misinformation that they receive, oftentimes from the person who is pitching the annuity. And when you read that 180-page prospectus that comes when they send you the annuity, people scratch their head and say, I don't understand what this is all about. So I think my biggest takeaway is if the person knocking at the door trying to sell you a hammer is a hammer salesman, and that's the only tool they know how to sell you, that's really, really tricky, because the hammer is in fact a good tool, but for a very specific project. You don't want to say, hey, I can do everything with just a hammer alone. It's really tough to drive a screw into a wall if all you have is a hammer. And so the idea here is try to understand the person who's presenting the information to you, and you want to make sure that an annuity is like, if it is a hammer, right? You need more than just that. You need a screw. You might need a screwdriver. You might need a tape measure. There's a whole bunch of vehicles and instruments and tools that exist out there when you're building a bigger plan, a bigger project, in order to make sure everything kind of gets incorporated correctly. So, Dean, we appreciate you jumping on with us today.
Thanks, man. It's good to be here.
We'll talk to you again soon. Thanks, Dean.
Thanks, Dean.
All right.
This next segment we call our client mailbag. Every month we have invited our clients to submit questions for us to read off during our market minute. And this month, one of the clients submitted this question: how anxious should I be regarding the upcoming presidential election and its impact on my retirement? Scott, what do you think?
Great question, and this is one we field with a ton of frequency. This question comes up multiple times daily, it seems, and so I think what we're trying to separate here is the policy and cultural and other impacts of an election from the actual economic and market impacts. And we're not gonna delve into the first part, but in terms of market impact, less than one maybe expects. And what we've seen over time is it's not as important who is in the White House for market returns as it is who's in control of Congress. What we see on this slide is when we have either divided government or Republican-controlled Congress, regardless of who's in the White House, that's where we have optimal returns. If we have a Democratic president and divided Congress or a Republican Congress, returns are right around 3%. Similarly, for a Republican president, divided Congress or Republican-controlled Congress, similar outcomes. Where we see less than optimal outcomes is where we have full Democratic control of both houses of Congress, and that's what the data shows. It does show when we have full Democratic control of the presidency and Congress, returns are about 9%, which is less than the 13% under other scenarios. The worst outcome is a Republican president and a full Democratic Congress. In all likelihood, we will see some form of divided Congress, which historically speaking is pretty good for markets.
I think it's, the obvious reason here is the market wants predictability, and it wants to be able to understand what to expect. That way they can kind of plan for, the future. And, if we have a divided system of power, that creates a lot of gridlock, which does create a lot of predictability. And so what I tell people, in the short run, you will definitely see some volatility that happens during election years. In the long run, much less impact than you think.
And that's a super important delineation, Paul, because I don't think we're suggesting, hey, it's going to be smooth sailing, no volatility between now and November. We may well see that, but as long as one sticks to a coherent investment strategy, there's not typically as big an impact based on who's running the government.
Steady at the helm.
Yep.
Our last segment, we'll go ahead and turn over. We call this our planning tip segment. And this month we decided to hit an interesting planning tip. We call this the spousal election hedge. And when we talk about Social Security filing, everyone's familiar with the concept that you can file your Social Security beginning at age 62, which is your early Social Security benefit, and you can go all the way to as late as age 70, which is a delayed benefit. Somewhere in between those numbers is your full retirement age, and that number will be assigned to you based on the year you were born. It can be as early as 65, all the way as late as 70, and some weird variation in between based on the year you were born. And a lot of times people will get this idea that they need to wait until full retirement age to turn on their benefit because that's when they max out their benefit. That's not true. The benefit actually works on a slope. And so you start at 62, you dot a line all the way to 70. And that midpoint of the slope where your FRA is the center of the slope. And so the spousal election hedge, what we're suggesting here is while both spouses have worked, if both spouses have worked, there's an opportunity to have one spouse turn their benefit on at age 62, the earliest possible benefit, assuming that spouse has retired, so they're not continuing to work because you can be penalized for working and drawing early benefits. But if they've stopped working, turn on that benefit early, while the other spouse would leave the benefit in deferral all the way till age 70. So you split the difference and hedged here. The idea is that if I'm gambling that both of you are going to live to be 85, that's not a really high probability. But the fact that one of you will live to be 85 is a much higher probability. And so what we're gambling on here with the hedge strategy is that if we can get the longest dual income lifetime that we can, right? So we've got one turning the benefit on at 62, then a surviving spouse will have that higher benefit. It's almost an insurance policy for the household to say we've got one benefit that get kicked out in deferral. Whoever lives, whoever dies, the surviving spouse will receive the higher of the two benefits all the way for the residual part of their life, which could be well beyond age 85. But then we've maximized getting some early cash flows into that retirement picture. So this is called the spousal election hedge. It's a great planning tip. As with all planning tips, you definitely want to sit down with us over here at Alliance Wealth and talk through these specifically to your situation.
I love this one, Paul, and the reason I do is this allows you to do exactly what you've talked about, to hedge against possible outcomes. What you find mathematically is this hedge gives you similar lifetime benefits to both spouses taking it at age 67, but you insure against the possibility of a premature death, which is a great hedge to have in place.
Well, we sure appreciate all of our clients jumping on here today with us for this month's AWA Market Minute. And until next time, thanks, everybody.
Thanks.